Hello, friends and fans and listeners. We are back today.
Like that start.
Yeah, episode 95, guys.
No enemies this time?
No enemy. Yeah, enemies as well. Might as well.
Might as well, if they're
Couple
listening,
of
huh?
enemies listening.
Well, they like and
man.
subscribe.
Yeah, might as well like and subscribe. Exactly. The crew is back. Tyler, our staple again, back full-time TI.
Yep.
We love to have him. He took back the OG seat here on the switchboards. That was also an epic fail this morning. Pre-recording already. We had some technical issues.
Technical issues.
This is round 8.
I didn't set it up.
Well,
Lisa
let's
set
leave
it
it
up.
with that. And Keith, staple,
Yeah,
he
go
needs
ahead.
to listen already to all of the
All the
bickering
banter.
between
Yeah.
Tyler and I.
Next stop is HR.
Exactly. Well, anyways, we have a lot to talk about today, so we have to get going because there's a lot going on. We're pretty busy this week with markets and volatility and all of that, because we have a war now in Middle East, Iran. The U.S. and Israel attacked Iran over the weekend. It's still ongoing, so we will talk a lot about what actually does that have to do with the markets, as a lot of investors might ask themselves what that means for their portfolios. So we traditionally start with true truth and a lie. And I brought a little Middle East / geopolitics addition to that. So A, roughly 20 to 21 million barrel of oil a day, which is about 32% of the daily global oil consumption, crosses the Strait of Hormuz, now basically closed because of the war. B, historically, the S&P 500 has declined about 0.9% on average 1 month after a major geopolitical shock. However, 3-month mark after, returns have typically turned positive, averaging around 0.8% plus. Or C, the US is much less vulnerable to temporary energy price spikes now compared to the 1970s because of changed export-import dynamics. Keith, let's start with you.
Oh, this one should be good.
Yeah.
Well, we'll see. I think I got at least you got a lot of numbers in there, so we'll see with my answers. I'm gonna go reverse order. I'm gonna start with C. The U.S. is much less vulnerable than in the past. I think that's true. Versus the 1970s, I think we produced 10 to 12, maybe even more now barrels per day, which I don't think we did back then. And I think we're less dependent that way. And I think we would probably get some imports from more friendlier countries that are near us. So I'm guessing that one's true. B, obviously, when there's a conflict, a dust up, whatever you want to call it, a war, but it's markets do generally knee-jerk reactions down a little bit, which is 0.9 you have in there. That sounds reasonable. But then shortly thereafter, markets usually shake it off and kind of back to fundamentals. And I think B is also true that 3 months were actually positive, and then you go out farther, I think you get back into the long-term norms. And so that by default, I think the roughly 20 to 21 million barrels a day, 32% going through the Hormuz. I think that's too high. That maybe was the case in the past. So I think you did something with the numbers there. I think that's lower. So A
is the lie.
The lie.
That was good reasoning, Tyler.
Yeah. I do think there still is quite a bit that goes through the Strait of Hormuz, which is partly why the oil markets spike when you start to get that kind of stuff, when you have that closure or conflict, whichever conflict it is. I would agree with Keith on B. Like, that sounds about right. You get some price shocks to go lower initially, and then it kind of just shakes out after. Yeah. So I am going to go with C as even though the U.S. does export, I think it's like 11 million barrels a day.
Well, 10 and 12 wasn't bad. Yeah, you're the energy guru.
Just because of that, like, we still have oil price shocks regardless of what's going on, because we export most of our own oil and we have to import most of ours just because of the
light
difference.
Crude and heavy, yeah, crazy.
Most of our refinery is heavy sour versus
sweet.
What we export is sweet light. So I'm going to go with C as the
nice
lie.
Lisa, what do we got?
Well, I'm very pleased to say that I got Tyler on this one.
It's off to a good show start.
C is actually true. So the US is less vulnerable. It's not completely out of it. I mean, we saw that with energy markets and oil markets, but it is less vulnerable compared to the 1970s because we're a net exporter of oil now. And we can also ramp up production much more quickly, the US. So it's just still, temporary shocks, but more self-reliant and therefore less vulnerable overall.
I would disagree with that.
Okay.
Oh boy.
You can do
Fact
your
checked
research
after,
on
yeah.
that
I'm going to
after.
come back
Fact check
next week
this.
on
Got it.
episode 96. Stay tuned, everyone.
The reason is we produce about, call it, I think it's like 12 to 13 million barrels a day, and we export 10 to 11 of it. It's like, are we really relying? Because literally all 70% of our refining power is based on heavy sour.
There's some other factors I think that probably play into that.
Yeah.
And if you 70s is back when.
And when
was
you have like in the
actually around.
70s, like the oil price shocks, it's just not as
I guess that's fair.
it's just
Yes.
not as a
The
heavy
lines of
impact
pe- yeah,
anymore.
the
It's a
lines of
different
people-
dynamic because
That's
of
fair.
export imports. So,
Yeah.
so less vulnerable, not completely, out of it.
Don't
That's
drive a day
not-
of the week. People waiting at gas stations. So
Yeah, right.
Yeah.
Okay.
I'm gonna
So
fact
what's-
check
what-
this.
what's the-
I'm fact checking this after.
You can. There's nothing wrong. B is true. That's actually the right numbers. I tampered with A. So it's 20 to 21 million barrel a day crosses the Strait of Hormuz. And I've watched a documentary on it. Very interesting. It's like it's so narrow that it's like basically like every way, like the way in and the way out is only about 3 miles broad, which is very narrow for like given the size of the tankers and kind of that it's the sea. So and the one side is completely controlled by Iran, and that's why it's closed now. It's not 32% of daily oil consumption; it's more about 20%.
wow. Tyler,
So
there you go.
Keith, your reasoning was spot
Dang.
on.
Wow. All right.
All right.
Time
Take
for me
the
to bow
defeat,
out.
Tyler. Anyways, let's stay with this topic a little bit with geopolitical shocks and wars and conflicts. Because how are stock markets actually reacting to that? And the interesting thing is, it seems a little bit counterintuitive because it always seems like, oh my God, everything is down and everything is, bad. And while I do not want to diminish that, like war is always bad for people involved and for human life and all of that. But we will talk today about connections with the markets
Yeah.
only. And a market tends to shrug it off pretty quickly, which was interesting as well, because when we saw it, like the markets are open to the third day today, Wednesday, March 4th, when we were recording. So we saw Monday, the first day open after the war and started, and then Tuesday, and the 2 days behaved very differently. On Monday, kind of, we had a little ups and downs, but it was kind of not as bad. And then the market, I think, marginally closed up, so it was not that bad. Yesterday, we had the full blow, I guess.
Yeah.
Finally, like with the volatility all around the place, markets down, precious metals down, oil up, like the full blow actually. But Keith, can you talk a little bit about why markets tend to be initially volatile, but really don't care all that much when we are 1 month in or whatever?
Yeah. I think the knee-jerk reaction markets don't like uncertainty and unknowns. War certainly creates that, all over the place. Whether economic impact depends on what territory it's in or what part of the world, right? That could certainly impact economic activity for U.S. more than other places. And then especially in the Middle East, you kind of draw the Middle East usually tied to oil, which you kind of covered that already. It's usually tied to oil, any disruption in oil, which potentially could have oil prices going up. And oil prices, you're right on the stock market. I think was up a little bit on Monday. Tuesday was an ugly day. Really ugly midday. It finished better, still down. But the one thing, price of oil itself had two pretty big up days. I think we're gone from roughly not too long ago in the mid to lower $60 price per barrel to mid 70s. So that's an issue. I've been saying, so I think that's why in the short term markets react, but then ultimately if they focus on company fundamentals, economic activity, what's actually getting impacted, and there's some winners and losers that way, but in the end, I think vast majority of these economic activity just continues. So I think that's what investors refer to. So, and then, like I said, the price of oil, which I've been saying has been a underappreciated tailwind for the U.S. consumer, just because it's been lower. I think it's helping inflation being held down, or at least going back to what I would say that 2% Fed target is. Now, that's one thing I will have to reconsider for myself investing in the portfolios we look at, is if price is going to be in the 75, going a little higher because of this uncertainty, that could potentially be a headwind for consumers, which is a big part of the U.S. GDP. So it was underappreciated back when oil prices were going down. So now I have to change my stance a little bit. If I think this is going to be extended and oil prices are going to stay high, that it could be a little bit more of a headwind. Maybe stats over time change a little bit.
And I mean, when we talk about like staying with oil a little bit, because some people might ask, okay, why is the Strait of Hormuz so important? First of all, and we clarified that first, like 20% of global daily oil consumption goes by that, not only from Iran, and Iran is a major oil producer, but also Saudi Arabia. The whole Gulf states basically travel through that. And when it's closed, you can just not easily go around. I mean, it takes like from the Gulf Coast, for example, to Hamburg, Germany, where a lot of these container ships initially go, it's like 14 days travel. When you ship them around across, around the Cape of Hope, Africa, it takes 14 days extra.
So that's double the time.
Double the time. It kind of gets supply chains all crazy. Insurance for these tankers kind of gets much higher, so that influences the price as well. Not only the length and the impacts to supply chain and how long it takes, and how less efficient it is, but also to actually insure the travels and the journey. So all of that goes into the oil price. But Tyler, I want to, and Keith mentioned it already, like inflation. The energy prices are a huge part of inflation. And we kind of are still, inflation is still not where we're comfortable at, still not where the Fed's magic 2% target is. What impacts do you think we can expect? Like, does it depend on how long it goes? Or do you think, okay, if that is resolved quickly, that we bounce back and get everything in order again without seeing a whole lot of impacts? Or do we see, as we are today, can we expect inflation pressures already just these couple of days in?
Couple of things. So when we're paying for gas, so oil goes into pretty much everything at this point, right? I think I've talked about Landman,
microphones,
opening episode, opening scene of Landman. They talk about how significant the oil market is. So it does have an effect on input costs for every company at some point. Do I think they react to something like this? No. And then also when you talk about oil at the pump, what a lot of gas stations tend to do is they try to smooth out the rise in prices of oil. So what you'll typically see is they'll end up eating cost when you see an oil spike like this, and then they'll slowly raise their prices. And then as oil goes back down, they're not going to lower it as quickly as the barrels of oil cost is, right? So they try and smooth that ride out a little bit. So at some point you will see it, especially at the pump, you will start to see this price spike. But I don't think this is going to be a long-winded thing. So my take on the whole Iran issue is I always think back to the Venezuela aspect of it. So we obviously kidnapped or took, or however you want to frame that, the Nicolas Maduro, president of Venezuela. And so Iran has been going through quite a few issues in the last month and a half. There's been a lot of riots. There's been concern over their central bank. There's been concern over their currency, over inflation. And so what I'm kind of gathering from this is that there was more of a breakdown in communication between U.S. and Iran, because that's after we initially bombed the nuclear facilities
last summer, right?
We engaged in talks with Iran to whatever they were talking about on nuclear. So I'm guessing that there was some breakdown in communication between the U.S. and Iran with everything going on. And so if US is wanting to stage some type of attack like what we are seeing right now, one of the closest partners for Venezuela is, or the top 3 partners for Venezuela was Iran, Russia, China. And so if you want to make sure that nothing significant happens to US mainland, you have to make sure that your I's are dotted and T's are crossed with the closest ally to those countries, to the US, if you don't want anything to happen on US mainland. So that was Venezuela. I think the oil coverage that, we're getting 800 million barrels or whatever it was that Trump said from Venezuela, I think that's more of a cover to have more of a defensive strategic position. And then now talks fell apart significantly. And so now we start this, if you want to call it war with Iran. But like Russia's too tied up with Ukraine still to actually.
That's why we are seeing no really step in from Russia to Iran now, because they don't have the means to do that at the moment. Yeah.
And then China, I don't think, wants to disrupt the partnership that they have with the U.S. and actively engaging in any type of war with. I've seen videos of China ground to surface air missiles that they've been mobilizing them, but I don't think they're going to actually do anything. And so now and then Iran starts bombing U.S. targets in UAE, Qatar, like all these countries that were supporting Iran versus Israel last summer, but now they're not supporting them because they're actively getting bombed.
Yeah, which is not.
So Iran's kind of like on an island at this point. So I don't think this is going to be a long-winded thing. I think they trade some blows back and forth. Iran mobilizes their extra troops outside of Iran, like all the different fractions that they have. But I think it's going to be a short-winded thing, and somehow Iran's going to position it that they won because they hit the U.S. targets, they hit U.S. bases, and in a week and a half they're going to start saying that, yeah, we're going to engage in conversation, and then in July we're not even remember this happened.
Mm-hmm. Wow, bold prediction.
Mm-hmm. That's my thought on this,
and that's also interesting, and that kind of feeds back to what we said in the beginning, that the U.S. is less vulnerable to oil price shocks right now than it was back in the days. Because when you compare the U.S. and its vulnerability to that at the moment to Europe, for example, the story is a complete different one. Like over there, like this is craziness. Like gas, oil, like this is all natural gas, all spiking because of kind of the not dependence or dependence of the European Union, Europe as a whole, to other oil producing countries. And they have like heavy industry, like heavy, chemical companies, automobiles, like heavy industrials. They're already struggling with that. And now they have to fill up their gas, tanks for winter. Like I think they are kind of nervous already, because by November it needs to be 75% full, and they have to, buy, and for the government and all of that to get through the winter. Now it's like, like depending on how long it takes, that can have implications for the economy over there much more than it is in the U.S.
Since you are resident expert European, how does that, if that's true, kind of what you just said, does that, obviously there's been a broadening out of the market we talked about last year. International markets doing very well. International markets this year are off to a great start compared to the U.S. markets. Now what you're talking about, is that, do you think that kind of maybe dings that thesis that international markets will continue to outperform, or is that just something that...
It definitely can have an influence, because they're so dependent, and we already see the spikes, and they're already struggling with energy and high energy prices. It's insane what gas and oil and everything costs over there. Like I'm shocked every time I go back, to be honest. And again, like for companies over there that are generally more industrial heavy, energy heavier consumers, I think the longer it takes, the worse it can get. I think when it's really like contained a couple of weeks, and then we go back to normal, and supply chains kind of are able to smooth out again, maybe there's might be some benefits down the road in Iran, if that gets more open with oil supply going forward. That is maybe a little bit better, or supply from there. So I think it's nothing too crazy now, but I think the longer it takes, when that drags on a couple of months, I think we can see some troubles.
Okay.
I still think it's fine internationally. So when you think about specifically the EU,
Mm-hmm.
like we heard, what was that, a year and a half ago now at this point, where they, or was it beginning of last year, where they boosted their defense spending?
Mm-hmm.
And I think from the EU's perspective, and this is just my hot take on it, is that they're going to continue to open up spending over there. Because historically they haven't, right?
That's right. But if you have like all of this defense, that's heavy industrial, heavy energy consuming.
Right.
And if they already have like such a big headwind with a lot of companies thinking to move outside Europe because they can struggle to keep up with that, they keep on spending, yes, but it gets even more expensive because these sectors need a lot of energy, right? And if you have like a prolonged war, they are just more dependent than the US. And if that drags on, that can be a headwind.
Yeah.
But
I just don't think it's going to be a long-winded
right. That's what
that happens.
I don't think either. So it's like I think it should go back to normal, and that should overall, if we do not see a prolonged war, we should probably be able to kind of.
But the EU has also started to diversify where they're getting their LNG from. Right. So initially they were getting a majority of it from Russia.
Yeah.
Right. We heard about that with the pipeline bombing that happened last year. Whereas over the last 2 years, the EU has started setting up new import areas.
That is right. But do you think
LNG.
the US sells its oil cheaper to the EU than Russia did? It's much more expensive for Europe to import from the US. That's why they didn't do it in the past. That's why it was Russia and not the US. And obviously the US is envy to sell its oil to Europe, but it's more expensive, more complicated.
Yeah.
That's why it was Russia. And that's why, I mean, it's their own fault. I mean, they were zero diversified. And I mean, since Russia invaded Ukraine, they have like an energy crisis. And obviously they're diversified, but it's not, as cheap anymore.
Have they already been experiencing the rise in cost because they have been diversifying from Russia? So
before that?
Yes.
Yeah,
so
but not meaningful.
Is it less of a price impact?
So what I can see over there, it's like it's not fun. It's pretty bad, actually.
It's a lot bottom line, there's a lot of things going on. A lot of moving parts that we don't. I mean, obviously, we have to take stances in kind of how we position our portfolios and whether
I would
we
say
like
if
this
it's
or
not
that.
taking all that long, and which I think the overall consensus is for that, then I think they should be fine and should bounce back pretty quickly.
I think that's the
but it's
overall
also
consensus view that this would be a shorter war. Now, I think we do have to keep watching news headlines to see if it's going to be longer or more chaotic. I think then there could be some potential, at least headwinds for the markets. Some of those tailwinds, I mean, we always talk about what's the one indicator for what's going to drive the stock market for the year. At least for me, it's earnings growth rate. We just finished Q4 numbers were up, I think, almost 14% for year over year on the quarter itself. The numbers for the full year are close to 15% for guidance. That hasn't been impacted yet.
Right.
So
that's what drives the markets in the long run. That's what we always say, right? It's earnings, it's the economy, and that's what the market reacts to. And that's maybe a reason why it bounces back so quickly.
I think that's the ultimate reason. So but we certainly, this is nothing to completely ignore.
Mm-hmm. Perfect. So that was it for G. Any other adds to that, Tyler?
Good.
Okay. Anyways, I want to touch on something else today as well. Short. Did any one of you actually read the Citrini? I don't even know how to pronounce it. Citrini report that came out beginning of last year that kind of ruffled some feathers in the market. I've read it Friday afternoon.
Nice.
It's like pretty doomsday. It's like,
Yeah, I know.
holy. And it's like, it kind of is like in 20, it's a hypothetical situation in 2028, which is not far off, right? And what could happen if AI just kind of overwhelms everything and with everything that we thought was possible, and what could happen to the US, specifically the economy, consumers, white collar jobs. So Tyler, what you think about that? What are your thoughts?
I got about halfway through it. I was reading it on Saturday. It is pretty doom and gloom. I think they have some valid points of the displacement that AI can bring to specifically white collar jobs. And when you think about last year, the report came out. What was it? 54% of all consumer spending came from the top 10% of earners. So if you start displacing those people, and now they fall into the 50% or they lose their job and they don't reinvent themselves to do a blue collar job that we've talked about a number of times here, whether it's electrician or whatever, I think it becomes a big issue. But I think it's a little bit too gloom and doom. I do think a lot of these companies will reinvent themselves like they always have. They target seat-based software type companies. And I think there are some barriers to entry, or barriers to exit, if you will. So like Keith and I and Kyle were talking about yesterday. Salesforce is a good example of one that we're going through that right now, where we're migrating a bunch of our advisors from our virtual advisor CRM system or Salesforce system to a new CRM system. And it's a nightmare. And so I think that the fact that you can target and say that it's easy to switch from one thing to another, and you can go to some vibe coded software service that some Joe Schmo in his basement cooked up last night. Like, it's easy to say that based on what we've seen so far, but for an actual like corporation to go from like a Salesforce to a vibe coded thing that isn't proven is a little bit tricky in of itself, of moving the data. And then also, do you actually trust the vibe coded that they keep talking about, the vibe coded software that they're creating? I just think there's, and I still think maybe Generation Alpha is, so like I grew up with the internet, right? Generation Alpha is going to grow up with ChatGPT, with Grok, with Claude. Like, they're going to be more comfortable using it. So I think it's going to take time. It's going to take more time for this to play out than I think people are thinking about. Because even for me, I use ChatGPT on a daily basis, but I don't always trust it. Whereas you're like Generation Alpha might just straight up trust it and call it a day. So I just think it's going to take time for the adoption of all of this and just fully trusting the AI.
Do you think, Keith, that this was a little bit overblown, the market reaction, based on a blog post and I mean, markets tend to react more to Twitter feeds and kind of posts and stuff lately anyways. And it came at the point where investors struggle to figure out all the AI chitter, software sell-off. Then it kind of flowed into other areas like financial, for example, which again, this article also heavily impacted financials, because they also take on private credit and all of that, which is also struggling right now in the whole AI, figuring out what survives and winners and losers. So do you think it was bad timing?
Yeah, I mean, this is Citrini, the one that the AI wrote itself. There's two different ones that came out recently, so that was a different one. So I read a little bit of this one, but there was another one that was kind of doom and gloom that AI actually wrote itself.
Oh,
so it's
that's
just
even
like,
more
right. So it's just like
scary.
right. No, I mean, Tyler said it well. I think there's definitely a change. For me, I think the bigger change is that white collar versus blue collar. I think this is not a death nail to white collar, but it's certainly going to change the dynamic. I think it's doesn't eliminate all these jobs, but it makes people more efficient. So it makes companies more, the productivity actually goes up.
Hmm.
There will be some casualties along the way. So then,
But that's the thing. Also, the article kind of hit on. Productivity goes up, but the U.S. economy is heavily based on the consumer. Like over
70%, yeah.
70% is consumer spending. Well, if white collar jobs are getting lost, who typically drive the bus because they just have more to spend, if that gets lost, then there's also kind of said, okay, if white collar jobs, if they lose their jobs, they have to reinvent themselves at some point or have to go to blue collar jobs, which kind of puts downward pressure on wages there for the existing one and for the new entrants, because you just have so many more people all of a sudden wanting to fight for the same jobs. So even less consumption, but productivity goes up, which is said to be the ghost GDP that actually didn't
Yeah.
rattle through the whole economy. So do you think that's just a little bit more?
I think that's just too bigger picture doomsday
Yeah.
scenario. I do think that rotation is going to happen, and maybe those white collar, high dollar paying jobs rotate to those blue collar jobs.
Mhm,
Maybe they end up getting more high dollar, so that maybe the dollars don't necessarily change. It's just the who's going to get them,
mhm.
right? So it's maybe there's too much competition in the blue collar jobs, but maybe there's 8 other versions of blue collar jobs get invented and kind of.
There's going to be jobs that we can't even
That's
think
what I'm
of
saying.
Mhm.
There's going to be
that are
stuff.
going to be created.
Yeah, whether it's white or blue, it's just,
It-
and there'll be some value add. I mean, now if again, I reference, I got 3 kids in college. If you're an underwriter or some entry level programmer, it's probably not ideal. You
Yeah.
got jobs, but I think if you're working at a company, young person, old person, whoever, if you can at least kind of know what AI is and how you can make your job more efficient, I think you're better off
Mhm.
getting in front of it than all of a sudden,
Well-
oh, geez, I just
well-
got displaced by AI.
Well,
for-
take a pharmacy, for example, right? Like the pharmacist is not going to go away because you need someone to administer the drugs, explain it to how to use it, look at the other drugs that people are using and how they intertwine. Yes, you can use AI to help with that
yeah.
and be your own doctor. But at the end of the day, you need someone that actually can distribute that drug. And
But it's also a lot about trust, right? I mean,
yeah,
it's the
but
same
like within the
finance.
pharmacy, like I walk into a CVS, because I'm a type 1 diabetic, so I have to go get my stuff all the time. And it's like the amount of bags that they have for people is crazy. And the back office aspect of it, you can probably create efficiencies
100%.
there. But at the end of the day, the pharmacist is still going to be there.
Yeah.
You might not need as many, but it's still going to be
Or
there.
their specialty be something a little bit tweaked from they're going to do
Yes.
pharmacy and something, right? Maybe
Yeah.
they're already kind of going down that road of they administer shots, for example, which you never used to do a while ago. So it's
Yeah.
kind of interesting how that's just one segment that's kind of evolved
Yeah.
without even the AI. So jobs do evolve,
Mhm.
and I think that's what will happen with AI.
Definitely. Well, that was it for today.
Wow, good show.
Let's end on a positive note. It's warm in Minnesota. We are finally having
Yeah.
spring. I mean, second full spring. You can argue
The
that, but it's
35-degree
50s.
morning this morning felt great.
Oh, that's awesome. So Minnesotans have a great time today. Maybe we have 3 blizzards ahead of us. Who knows? But at the moment, we're enjoying spring life. Well, we will be back next week. See you then. Bye-bye.